There was a canal, and I think it changed its name to Canal and Railway. Again, stock price skyrocketed, etc. And of course, that was part of the kind of part of the theory. Okay, going back to James Morrison. So James Morrison was really vehement. Okay, so I mean, he was a free trader. Okay, he was a kind of great fan of free enterprise, and so he made a huge pile of money that way too. But I mean, he was looking at it and he was saying, look, railway is somehow a proven thing. Okay, how can these people expect 10% out of something which is about as secure as government obligations, which pay 3%, etc. Okay, so he was in favor of limiting the rate of return to 6%, and the railway industry was against and fighting him. A few years later, 6% was unimaginably high, etc. for them, etc. That's a different story. But his view was, look, this has been proven. It's fine to pay the pioneers, the ones who took real risks. It's okay for them to get a 10 or 15% return. Why should these guys who are doing the obvious, the guys who are kind of sometimes almost fraudulent promoters, like the Glen Matchkin railway boys who want to have a placard, a public pigeon, why should they get 10%? No, it's not reasonable. Okay, so that's one story. The other story about the rate of return. Yes, so basically, when you look at the whole British railway industry, so common shareholders really got wiped out. Okay, step back a little bit. There were extremely few bankruptcies. So why? Because British Parliament insisted on very low leverage. Basically, normally when you got a charter, the charter only allowed you to have about 1/4 of your capitalization in loans. The rest had to be in equity. Okay. Now, actually, people found ways to get to raise it through guarantees and other kinds of things, but because of still limitations, very few of them went into bankruptcy. And again, this is in terms of law, bankruptcy law in both the United States and Britain got huge impetus from railroads. Okay, and in particular, okay, I mean, just one example. There was this theory of Diodens. Some of you may know it, I forget even the name. There was a theory that if some object was used to kill a person, okay, that object would then be seized by like relatives or the family, etc. Okay, does anyone know what exactly that term was? Diodens, right? Okay, and so what would happen is that some passerby.
George Mason.
So a passerby. So a passerby would be killed by a locomotive, and now the local sheriff would seize the locomotive. Okay, and somehow people were arguing that doesn't really make sense for society. Okay, yes, maybe the railway has to pay some compensation, but why keep the locomotive out of service? Okay, so law eventually got changed. Some other things, again, in those cases of bankruptcy, which were very rare in England, but very common in the United States. The United States had very high leverage. Bankruptcy was very common. The issue is, what do you do? Well, traditional solution was you liquidate. Okay, and in Britain, of course, the people involved in these things go to jail. Okay, there was debtor jail in those days too, etc. Okay, but anyway, so you liquidate. Okay, it didn't make sense. What do? You tear up the rails and sell them for scrap iron. You really want to keep it. Okay, so eventually, either through legislation or courts or combination of the two, the law evolved to compensate for it. Okay, and again, beautiful things. You hear the complaints about modern management. Wow, you should read the complaints about management in those days, and in particular those complaints about, here's this management which drove this line into the ground, and now they are being protected in bankruptcy and given retention bonuses and such like. Okay, that sounded to people kind of not very reasonable, but somehow society decided it was really more productive and accepted it. Right. But okay, go back to your question about rates of return. So there are relatively few bankruptcies. If you look at the total amount invested in British Railways by, say, 1850, 1851, 52, total return to capital was about 2%. Okay, so 3% was a risk-free rate of return on government consoles, and so if you got 3%, well, private business people expect to get at least 4 or 5, etc. 2 was definitely poor. But remember, 2% was total return. You had to pay first the bonds, and then you had to pay the preferred. Okay, and in many cases, the common shareholders got 0. in particular Bronte sisters. So they invested all of their kind of money into railways. The main investment was a York and North Midland Railway, and I think there is a letter of Charlotte Bronte. She was the last of the sisters to survive by early 1850s. There's a letter which she kind of talks about, well, at one stage the shares were at 120, now they're at 15 or something like that. And there's a friend writes to her from New Zealand, where this friend emigrates, saying, look, eventually railways are going to recover, etc. But people like the Bronte sisters, they really suffered. The common shareholders suffered. So if you look at some of the popular accounts of that period, they present kind of real doom and gloom picture of, but that really represents common shareholders. And eventually returns improved.
Well,
even common shareholders got
yeah,
started.
man, when I have a stock that used to be 120 and it's now at 15, I call that stock one of my winners.
Well, okay. I'm
0% return.
Yes.
I'm getting very jealous of that bubble.
That's right. I'm very glad that you're.
That's a good way to bust.
I'm very glad that you're rich now that you can take that attitude. Very good.
Sir, could you illuminate the sources of the capital? Where did the 200 million pounds that was invested in British Railways come from? Out of whose pocket? I think it might be worth noting that the investments for the investments for the dot-com bubble probably couldn't have happened unless there was a private pension system, the 401ks, and all the vehicles of private savings. So where did the British
individual investors. You didn't really have much in the way of private funds. There are some insurance companies, not very much. It was primarily private individuals. Actually, there is still a very interesting research topic there to investigate what happens. So, but generally speaking, if you look at history of British railways, you can get pretty good coverage up to about 1843, 1844. And then almost everybody who tries to do a comprehensive account of finances or other things gives up because of the mania, and nobody quite understands it. So there's a very good book about finance of British railways up to 1843. It's based on a few lines, not everybody, etc. But this chap, I forgot his name. I can get you, the precise reference. Has very solid, information about it. We don't have such information from the late 1840s. And in fact, it's a very interesting question. There have been some recent papers in accounting journals about really what happened. In particular, there was one paper which kind of claimed that this was all a great swindle, that the share brokers kind of pumped things up, dumped them on the kind of unsuspecting public, and then bought them up inexpensively. I don't think that was the case, and there will be some rebuttals to it later by others. But we still don't quite know. There may be, so the general popular conclusion at the end of the 1840s was that most of the capital was coming from relative kind of middle class, tradesmen, and kind of other people, and the small farmers. But it's not clear. We don't quite know, and we don't know how much of a distribution took place. We certainly do know in the beginning stages of the promotions, large bulk of the money promised came, to make it intelligible, let me take another minute. In those days, you didn't just buy a share at IPO and then forget about it. Okay? And this is, so if you read the Glenmatchkin Railway story, you'll hear about subscribers and other kinds of things. In those days, it operated more like a venture capital fund does today. So if you happen to be running a university endowment or some insurance company, and you want to subscribe to a new venture capital fund, okay, you subscribe 100 million, okay. Now that doesn't mean that you send a check for 100 million to the venture capitalists. It means that you stand ready to provide the money as the venture capitalists find appropriate investments for it. Okay, this is how it operated with individual investors. In Glenmatchkin Railway, I think the shares are £20 each. There's an initial deposit of £1. This is what's used for preliminary expenses to do the surveys, go to Parliament, etc., etc. If Glenmatchkin Railway got approved, then eventually the directors, every few months would be sending in calls saying, send us another £3, send us another £4, etc., etc. Okay. In the initial stages where people just subscribe and put down a pound deposit, This had to be documented for reasons, again, I won't go into it, it's got a very interesting story, but Parliament wanted to see the subscription list, and we have statistics on those. And of course they are somewhat faulty because sometimes people were agents for others, and again, some other long stories. But basically we have some statistics, however misleading they might be, which show that a large bulk of these subscriptions came from very wealthy. Some aristocrats, bankers and such like. Okay? The general opinion is that, and we don't quite know because we don't have documentation, is that by late 1840s, at a stage when most of these calls had been issued, when people had to pay up, the £20 out of the £20 shares had to be sent into Glenmatchkin Railway directors, claim in popular press was that most of that money, most of our shares are in hands of small tradesmen and other people. We don't really know that. That really requires some research, documentation.
That staging process sounds like a great way to get a stock market bubble going too, because you only have to put down £1 in order to have your
absolutely.
share, which
Right.
you then sell to someone else for £5.
That's right. Absolutely. And you certainly see it in the Glenmatchkin Railway story, and also this is kind of what makes the whole thing, easier to understand, but also kind of harder to understand why it went on as it did. So it happens, you have a first wave of kind of really almost crazy promotion in 1844. 1845 is a peak. Glenmatchkin Railway story appears in October 1845. November 30th, 1845 is the peak. This is when the deposits are due with the Board of Trade of all the plants and such like. Okay, and this period of 1845 is really crazy. I mean, in some of the popular books about manias and such like, you hear all these accounts of crazy events, people selling shares before they are issued, all sorts of things, people going bankrupt, crossing the seas to escape, going to debtor's jail, etc. It's all true. I mean, maybe exaggerated, but a lot of it really happened. And people were not really paying attention. They were just going to get a share, sell it, and potentially get a premium and such like. But now, comes November 30th, all basically dies down. Now they go to Parliament, and now they have time for second thoughts. Okay? First of all, Parliament scrutinizes these projects, but also the shareholders now have to decide, do they really want to proceed with it? Okay? And in most cases, they decide to proceed. Okay, and lose their shares. But yes, the early stages, 1845, it was absolutely crazy seeing those stories in Punch, and wonderful stories are only slightly exaggerated. Glenmatchkin Railway stories only slightly exaggerated. But this was for relatively small amounts of money. These were essentially options, like £1 out of 20. But once you got beyond that stage, if you went through Parliament and got approval, then you had to put up the remaining £19. And that's when people really lost their shares. So the first stage, even though it's crazy, it's kind of, must say, excusable. There was a phrase I heard from at least two people about the internet bubble. Why did it get as crazy as it did? Why didn't people pay attention? Both of them, people who are involved in the industry, say there was no time to think. Okay. One of them is a science journalist. He says he was covering OFC, a big country, he says 1,200 exhibitors. And he had to cover all the new technologies, and there were 4 days. How do you cover 200 such? He said he had wondered about these stories about demand growing and traffic growing. He was curious about, but he was just too busy. He had all these other things to do. Okay? And another person said something very similar. So, same thing in 45. The rush, effortless riches. Get those shares, get those premiums, etc. Persuade the directors to give you an allotment. Okay. It's not all that irrational in many ways. It's the next stage, 46, 47, 48, where they persist and pour in all this money and build things out, where they have time to think and they somehow don't really see the problems they are facing. But yes.
I'd like to thank Tom Donlin for that, from Barron's, for that question, even though he suspiciously refused to identify himself. But I say that for the audio feed of this, which will be posted on our website and is available through TalkShoe. We're going to move this out to the atrium when we have a reception waiting for us, and I'm just really thirsty, so we're going to cut this off. You can ask your questions in person, And we will be posting the slides, if they're not already posted. The audio is going to be posted on the Information Economy Policy Project website, linked